Okay. And then what I'm going to do is somehow make this, hopefully the recording is recording the big screen on here. So if we have to send this to somebody, right? But when I became a financial advisor, they taught us that there's really like six key areas to your financial advising, to your financial life, you know? And I'll go over these six key areas as quick as possible. But the first key area is called your cash flow, cash reserve. So your cash flow is quite simple. It says basically how much money's coming in, how much money's going out each month. And you have to make sure obviously that you have some money left over at the end of the month. So we have to obviously make sure we're balancing our budget and we're not living outside our means. So one of the first things I had to do with my clients is just that. I had to look at how much they're spending and how much they're making, and I had to look for ways for them to free up more what? Discretionary income, more cash flow. Do you have too much? Do you have enough money left at the end of the month? Or do you have too much month left at the end of your money? And some adjustments that I would have to have conversations with people and have them have, hey, do you really need to go out to eat this many times? Do you really need to drink this much beer? Do you really need to smoke this many cigarettes? Do you really need to do these things? Or is this just a want? Tough conversations to have, but we need to free up an extra $100 a month for your family. Do you really need a home phone if everybody else has cell phones? I got many people to cancel cell home phones. The company, maybe it was AT&T, whoever was servicing the area was probably not happy with me because they were all calling and canceling their home phones, because what's the point? And they were right. And I'll give you a real secret. A lot of people are getting tax returns, right? Your tax refunds. You know what a tax refund is? That means that throughout the year you paid too much money in your taxes, and the government says, "Hey, you gave me too much money. Here's your money back." Does that make sense? Right? The average tax return in the United States is over $3,000, right? So that means the average person is giving the government $3,000 of an interest-free loan because they don't give you any interest on that, do they? So they're taking your money, interest-free loan for a whole year, and then halfway through the next year, you don't get your tax money till when? When do you usually get that money? After you file your taxes, is it like April or March? I don't know what the day is, but all the way into the following year, they finally give you that money back. What do you think they're doing with it? Just stocking it under the mattress? They're smart. They're investing in it. If you do the math on how many people get tax refunds, and then you take the average tax refund, sounds good, a refund. It's like trillions of dollars. If not trillions, it's high billions. So we are giving the government billions of dollars. Who's giving them the interest-free loan? American taxpayers. Interest-free loans, billions of dollars. And then they just give it right back to us, right? So why would I take that money and give it to Uncle Sam and get taxable? Why don't I take that money and put it into something that can go towards my family, potentially tax free? And that's what I would help people do. I would have them take the money that was going to Uncle Sam and I would get it back to their family tax free. So, one simple way to increase cash flow on a monthly basis is to stop giving it to Uncle Sam. $3,000 a year? How much money is that a month that you're giving to him? That's an extra $250 a month you're giving to the government that they're just going to give back to you. So why don't you put that into your monthly tax flow or monthly cash flow right now, and that'll increase how much money you have on a monthly basis by how much? $250. Hey, even if you like to get a nice little tax refund, then just here's how you do it. You just like reduce, right? Your withholdings. Okay. You just have them withhold less for taxes out of your paycheck. Simple as that. Most people are W-2. They usually work for somebody else, so they have to usually go through their payroll system to have that handled. But if you are 1099 and you work for yourself, if you're a business owner, and you don't really got to worry about that. You're already winning in the game. So that's the first way. Tax flow. I could go over tax flow for a while, or cash flow. I'm sorry. I could go over cash flow for a while, but does that make sense on cash flow? This is the first part, right? Cash flow and cash reserve. What's cash reserve? We also have to make sure that we have money set aside in a cash reserve for not if, but for when a rainy day comes. That's called your rainy day fund. Did you guys know what the recommended amount of cash reserve is for a family or for a person?
3 months salary, right?
3 months living expenses. So 3 to 6 months is really what you want. You really want six, but we'll take three. Most Americans are month or week to week, month to month. Take a look at the average amount of money that the American family has saved up in a cash reserve right now. I think it's less than 4,000 bucks. I could be wrong. I'm just throwing numbers out there today, but I've done research on this stuff and things change. It depends on what website you go to, on what date. You know what I'm saying? But that's what I've been subject to is that information. So that's cash flow, cash reserve. Makes sense? Any questions on that? Good to go? Pretty straightforward stuff. Manage your cash flow and make sure you have a good cash reserve, you know? Second thing I had to do, very next thing after that, after we established how much money you have left over to invest, second area, protection planning. We had to make sure that two things for financial planning was making sure that your income continued to come into the family. Without that income, that cash flow is diminished. Without that cash flow, all the investing that we're going to try and do for our future is done. We could do all the planning in the world, but if we don't protect the plan, one thing goes haywire, income that's coming in is gone, plan out the window. So, how do we protect our income? Well, once you establish that you have an income, you can protect that income through disability insurance. So, the first thing we did is we made sure people had disability. I don't handle that anymore. I did that as a financial advisor. Most companies have short term disability, which only covers them for 6 months. So, if you get disabled and you can't work for 6 months, they'll actually pay you disability. So, good companies with good benefits will have that. What they don't typically have is long-term disability. So then I'd have to set them up with long-term disability. What that means is you're a truck driver, you make 50 grand a year, and all of a sudden you lost a foot. You can't drive your truck anymore, right? Well, you're disabled for the rest of your life, then we're going to keep giving you your income because you have a disability policy. You got disabled, and we'll keep giving your family that income tax-free all the way up until age 65. And you could have like cost of living riders and all kind of different bells and whistles on that. And you typically can get up to 60% of their income most of the time paid to them, but it'll be tax free. So it's like almost like 80%. Now, that's disability. But the other thing, how else can you lose your income? Well, everybody that woke up this morning and went to work, not everybody's going to be coming home today, right? Not everybody that went to bed last night is guaranteed to wake up. So next thing is when someone has income and they pass away, that income stops coming in as well, obviously. So we have to make sure that there's a life insurance in place that keeps the income coming into the household. God forbid that income earner doesn't wake up or passes away and that income goes away. Does that make sense? So that's the two ways to protect the family is making sure that the income continues to come in through life insurance and disability. Those were the two things as a financial advisor that they would have us do. The third area that we would work on families with would be goal planning. So everyone has short-term goals that they want to get accomplished. Whether it was I have my daughter and she's 10, but you know, one day we're going to send her to college and I need to do college planning, right? She just graduated college and they're planning on a wedding next year. So now all of a sudden I got to find a way to come up with 50 grand by next year. I'm like, oh, great. So there's a short term goal. Car, I want to get my son a car. We want to go on this trip. I want to do a party for my mom. It's going to cost 30 grand. It's her 50th wedding anniversary, right? Like those are the things that people brought to me. One guy, he played football in the NFL and he like wanted to get a boat and get this crazy expensive dog for some reason. So, I had to put that in the plan, right? So the short-term goals that are important to people, everybody has them. You should have them probably, right? So want to get a new house, save up a down payment for that new house. Big one, big one. All those things. Make sense, guys? That was the goal plans. And that was basically, hey, after we figured out how much money you have left over, let's say you got 500 bucks, we're taking 2 or 300 at putting that towards your life insurance for your disability. You probably got another 2, 300 left at the end of the month. What are we going to put it towards now? Put it towards that short-term goal, right? That's step 3. So we got the first 3 steps of financial planning down, right? Cash flow, cash reserve, protection planning, short-term goal planning. After that, retirement planning. Retirement. What does that look like? What does that shape in? Well, people would have to make sure that they're taking advantage of every aspect out there, diversifying their portfolio from an investment standpoint, from a tax standpoint, which is kind of like the next area we dive into, but just retirement planning in general. If they have company funded retirement plans, does it make sense for them to take advantage of that or to get matches on it? Are they good plans at all? Does it make sense to abort the company plan and just do something all on their own, right? Um, and how much money do they actually have to invest? What is their goal? What type of retirement do they need to live off of? So here's an easy thing, guys, is what type of retirement do you guys want to live off of when you retire? What do you think will be comfortable for you? Do you think that, by time you retire, you can pretty much have a lot of things paid off, maybe? You can maybe have expenses to where, they could be moderate and manageable. And maybe you want to retire with $100,000 a year, right? $100,000 a year, let's call it $10,000 a month. $10,000 a month. Okay, that's it. All right. So if I need $10,000 a month, right, where am I going to get that from? Well, my Social Security is probably going to be paying me X amount. All right, boom. We could count on 1,500 for your Social Security, maybe if we're lucky. So we got 1,500 over there. Other than that, we got 8,500 to go. So where am I going to get the rest of this retirement money? You guys know how to set up for retirement? It's it's like the most barbaric thing in the world. It's like an animal stacking up money or stacking up like acorns to live in the winter. It's pretty much what it is. It's like a squirrel who just gets all their nuts and it just has just enough stocked up to last them through the winter. You know, that's pretty much what we're doing through our whole entire lives. We're just stacking up all of our money until we have enough that we're like, all right, based upon my life expectancy, I got enough money that, if I live another 20 years or so, I should be able to get by. Does that make sense? Pretty much what we're trying to do. But in that case, you're not going to really leave much left behind for anybody. So you want to do retirement planning to where you could actually leave a legacy. So I don't want to get to a point where I have just enough for me to live off of. I want to get to a point where I have enough for me to live off of the interest that's on what I have, you know? So in order to do so, they say a comfortable withdrawal rate. So how much, if I have a hundred nuts, a hundred nuts saved up and I'm a squirrel, right? How many per year can I pull out of there in order to make sure that I don't diminish my 100,000, my hundred nuts that I have saved? Because my nuts are going to grow at 5% a year. So if I'm growing by five acorns a year, five acorns a year, I pull out 3 per year. Now, how much do I have left? 102. And every year I grow by five, but I'm only pulling out three. 3% is the withdrawal rate in retirement. I know that's a crazy analogy using acorns, okay? But we could use money. So, whatever amount of money you have saved up in retirement, you can live off of 3%. So, if you have $1 million saved up, how much can you live off of? 30,000. 30,000. 30,000 is how much a month? 2,500 a month. So if you have $1 million saved up, how much can you live off of per month? 2,500, right? If you start pulling out more than that, you're going to start eating into the principal and you're not going to really have much left behind to pass on to any other generation. So that's why they recommend that. Does that make sense? 3%. Now that's if you have a million, you can live off of 2,500 a month. Okay. And we need to live off of like $10,000 a month. So if I need to live off of $10,000 a month, then how much money would I need saved in order to financially support that? Well, if we know that 1 million gets me 2,500 a month, then 2 million would get me 5,000, and 3 million would get me 7,500, 4 million would get me $10,000 a month. If I had $4 million saved up right now, I could live off of $10,000 a month for the rest of my life and never have to worry. And then when I die, my family's going to get $4 million and they could just keep doing the same thing. But if I start getting a little, I don't know, aggressive with how much I pull out, let's say I'm like, I don't want to pull 3% a year. I want to start pulling 10% a year. Well, how long do you think your money's going to last if you're pulling 10% a year? Probably about 10 years, maybe 11 or 12 if you hustle it a little bit. Does that make sense though? So 3% is the withdrawal rate because that's hopefully you're getting at least 5% on your investment. You should have it invested at that point. And if you diversify it a little bit from a tax standpoint and things like that, you can even get a little bit more fancy. But keeping it for straightforward numbers, now you have $1 million, but where is that money saved up? You could have it in multiple different investments, all of them taxed different ways, earning different, rates of return. So that's retirement in a nutshell. We would have to help people plan for retirement. That was like step number 4. Step number 5 is tax planning. We had to make sure that people, when they got to retirement, all their money wasn't just getting taxed. So they say there's like 2 guarantees in life, right? Death and taxes. So one way that we would help protect against both of those is we would help our clients position themselves with cash value life insurance. There's really only 3 ways that you can obtain tax-free money down the line in retirement. And I don't know, do you want taxable money in retirement? Do you want taxable income or do you want tax-free income in retirement? I don't know. What do you think taxes are going to be 20 years from now? You think they're going to be higher or lower? I'm not a betting man, but if you were, what would you bet? Higher or lower? I'd bet higher too. So if I'm thinking taxes might be, you're going to be higher in the future, and I don't want to risk it, probably don't want all my money in a taxable area. So what can I do now to position myself in the future so that I can have tax-free money in retirement? So we would help our clients do that so that they're diversified from a tax standpoint. You guys, we all heard of diversification. What's diversification? That's saying like, don't put all your eggs in one basket. We all heard that before. Like, should I put my whole entire investment portfolio, all my stock, all my money, all my family savings in one stock? That would be risky. That's not diversification. They want you to diversify to what? Minimize risk. And it also allows you to take advantage. If one stock's doing bad, you could switch shift it over to stocks that are doing good. And you can, if one stock is doing real high right now, sell it off, take the profits, buy one of the stocks that are on sale. And you could, um, balance your portfolio on a yearly basis. So every year you would make sure that you would balance your portfolio to make sure your diversification was back to your original diversification that you wanted. Because throughout the year it goes out of whack. Some stocks grow, some stocks go down. So at the end of the year, the stocks that grew, you'd want to probably sell those off, capitalize, take advantage of that, and then go buy the ones that went down because they're still good stocks or they wouldn't be in your portfolio. They're down, they're on sale, and you buy them and it balances out the portfolio. That's a whole different conversation. Say, but we're talking about not diversifying from a stock investment standpoint, guys. We're not saying like, buy a little bit of this one, a little bit of that one, Pepsi, these stocks out there. We're talking about diversifying from a tax standpoint. Okay. Where do most people have their money for retirement? It's all in taxable areas, 401ks, IRAs. Some of it's in like side investments, like non-qualified accounts, like a CD at the bank, or maybe they put an E-Trade account. You could go online and open up an E-Trade account, start buying stocks right now, right? You could do that. That is taxable uh, on gains and interest. It's partially taxed. So you're still gonna pay some taxes on that. But the other area you could put your money into, like I mentioned, was what? Tax free. What are the three ways that you can invest your money now and later on when you go to take your money out, it's completely tax free? The first way is a Roth IRA. The Roth IRA works the opposite that a traditional IRA works. A traditional IRA says, hey, don't pay any taxes today. When you get to retirement and you take your money out, that's when you're going to pay taxes on that money. So it just sits in that account, it grows, tax deferred. So you don't pay any taxes today, don't pay any taxes while it grows. But guess what? When you take the money out, now what? Now we pay taxes on it. That's traditional. Roth, opposite. Roth IRA says, hey, pay the taxes today. You're going to pay the taxes right now. You get paid, they're going to take the taxes out. The money's going to go in your checking account. This is your after tax dollars, after tax. You can put that into this Roth IRA, and from that point forward, never pay any taxes on it again. So all the gains and the growth that you get on this, and it compounds over time and it grows, when it reaches retirement and you take the money out, completely tax free. So we're not saying investing any more money per se. For a lot of clients, it's just investing the same amount of money, but just diversifying it into different areas. The problem with a Roth IRA is what? Well, number one, they limit you on how much money that you can put into it. Why do you think they do that? Well, do you think that the government wants everybody getting a bunch of tax-free money? No. So they'll let you do it, but only up till this much. Like I believe it's like 6,500 for certain ages. At this point, it keeps going up, but there's a limit to it. Also, if you make too much money, you can't use it as well. So if you're like a married couple and you're making like over 200,000 on your adjusted gross, you're paying taxes on 200K, they're going to say you make too much money, you can't even use a Roth IRA anymore. You're not allowed to. So so it's good though, and recommend our clients to obviously take advantage of that. That's the first way. The second way you could get tax-free money in retirement is what? Municipal bonds. Municipal bonds are like a local school is trying to raise funds to build football fields, to build a new auxiliary center and a swimming pool or something, right? Fix up the playgrounds. So it's going to cost them a couple $1 million. So they're going to issue bonds, municipal bonds. Okay. It means there's a local municipality that's issuing a bond that people can buy into. And then they're going to give you a rate of return on that. Say, hey, if you let us borrow this money so we can build the school, we're going to give you 6% back on this money, interest. And the cool thing is since you're like kind of loaning it to the government, right? Then you don't have to pay any local taxes, any state taxes, or any federal taxes on them gains. So municipal bonds are what's called triple tax exempt: local, state, federal. Does that make sense? And then the third thing, and the third way you can invest your money and get it completely tax free, is called cash value life insurance. When you purchase a whole life policy and you qualify for one of those, the money that you put into your whole life policy, part of that money goes to build cash value. And over time, it compounds. And our rate of return is 4% with our company. So it compounds at a 4% guaranteed rate of return. And when you reach retirement, you can access that money completely tax free and borrow from it, right? So taxes in retirement can be pretty complicated. And I'm definitely not a tax expert at all. I don't profess to be one, but that's just the basic information you could look up on Google and you could figure that out. So what we would do is we would help our clients utilize cash value life insurance because most people either max out their Roth or they can't use it. So in that situation, you're like too rich to use a Roth anymore. You got too much money, you're maxing out your Roth, or you can't use a Roth. Or you can't use a Roth because you're making too much money. They won't let you. You're making over 200,000. So what do they do for what they call that the rich man's Roth? The cash value life insurance is the rich man's Roth. That's what people that are too rich, they're making too much money, they can't use a Roth, or they're too rich because they're maxed out their Roth IRA and they still got more money they need to set aside. So they just take a couple $100 a month and they'll double, triple down on a large whole life policy. And that's guaranteed to go to their family tax free. So it takes care of taxes for them up front because they can borrow from that money tax free in retirement. So personally, it gives them tax free benefits, but also when they pass away, all that money goes to their family tax free as well. And the government never gets their hands on that money ever again. So the last way, okay, there's 6 areas, and I'll end with the last one for you guys today, okay? The last area is legacy planning. Legacy planning. After we do all this planning, we figured out our budget, got you a cash reserve, set up protection planning for you, made sure you had plans to accomplish all your short-term goals, made sure we had a plan to position yourself to retire the way that you want to retire, when you want to retire. And then after we did that, we positioned you tax-wise to make sure that you're not paying too much to the government and getting that money back into your family's hands now and forever. And then the last thing we did after we tax planned is we made sure that after we did all this, that we have a good transition of this legacy from one generation to another. And what's the number one way to make sure that your legacy gets transferred to your family? Very simple. You got to have a will. That's the first thing we would do is I would recommend them to go meet with an estate planning attorney and I would recommend for them to get a will set up for themselves. I don't make no money off of that at all. I can't set up a will for them. But you know what the average will cost? $300. 300 for the cheapest one you could possibly find out there. Cheapest lawyer in the world will do it for $300 pretty much. Everything else it's up from there. I've seen thousands of dollars for these complicated wills. And then trusts would be another layer to it, whole different conversation. And then what we could set up for people that are really trying to build generational wealth will be what's called an ILIT. Okay. And a lit, let's just call a lit. A lit is called a life insurance trust. So you set up a trust with life insurance policies in it, and the trustees are the trust is the beneficiary of the policy, but the people who have the policies are able to borrow from it. It's like there's a policy on, or be a policy on me, but beneficiary would be the trust. So when I die, the money goes right back to that trust. And then the trust uses that money to buy more life insurance on more family members. And that's all it does. But I can borrow against it at any point in time as well. So the trust becomes this huge bank where their family members can just borrow from it and borrow from it and borrow from it tax free. And they don't have to worry about, and that's a way to like build generational wealth. Don't have to worry about taxes. And like if you have to go get a loan, you don't have to go to the bank and get a loan. You just go to your life insurance policy and get it for interest free loans. So it's kind of cool, if you really get into it and go down that rabbit hole. There's a lot of different bells and whistles you can add in there and different clauses you can put on it. But you could call what's called an ILIT. It's an irrevocable life insurance trust, which means no one can take it away once it's in place. So that's some layers to legacy planning. So those are the 6 areas right there. Does that make sense? Any questions on that type of stuff? How cool was that today? You guys got to learn that. What do you guys think? Is it worth it?
Yeah, I had a quick question for you.
Yes.
So do we offer ILITs and cash value life insurance to those on unions? Is this something that we offer?
Well, that's a great question. Yeah. So once again, we are not lawyers, so we cannot set up a trust, right? We can't set up a trust. We would be the life insurance company, though, that would provide the life insurance for that, right? So they would set all that up, and then we would just provide the life insurance to the family. Yep. Good question. But anyways, hope that was some helpful stuff. I went off on a on teaching you guys about that. But I'll tell you that is the basis of my general understanding of the financial planning for families, and then how the life insurance ties into how crucial that is, right? So what we do now is we don't do any of that stuff. The only thing we do is go to part 2, life insurance. That's it. We make sure that they have life insurance so that when they pass away, that there's things in place for them, right? So, when you take a look, there's I'm not going to go into it too much, but there's a lot of ways to understand how life insurance breaks down. So, the first thing I'll explain to you guys is typically, you're going to have like a need. How much like life insurance somebody needs is really important. You don't want to uh, sell somebody something that they don't need, right? So what you're going to have on here is you're going to have what's called need, and then over time, the need what? Changes, okay? So when you're young and let's say you're 30, how much life insurance do you need? Well, when you pass away at 30, the first thing your family is going to have to do is they're going to have to do what? Take care of the funeral. So for that, let's just say that you want to have at least 30,000 in place for your funeral, okay? And the next concern you're going to have to run into if you pass away is what? We'll put an F here for funeral. What's the next thing? If you pass away when you're 30, how would your
uh,
family be affected?
mortgages or
Debts.
loan.
debts, any debts. So you don't want to, here's the question. When you die, do you want to leave your family with a legacy or with a liability? What do you think
Like,
everybody tells me? Legacy. Well, most people that we meet with right now, if they passed away, they actually wouldn't be leaving their family with a legacy. They would actually be leaving their family with major liabilities. One of those major liabilities is like the mortgage. The average mortgage is like 200,000, right? So there's another 200,000 just for a mortgage. And then also you make an income for your family, right? So we'll put an I right here for income. If you pass away, your family is still going to need to pay the bills and eat food. So they're going to need that income. So if you make $50,000 a year, okay, you make $50,000 a year, Joe,
Mhm.
and you do that for the next 20 years, how much money are you going to bring into your family?
A million.
You're going to bring in $1 million into your household. So I know sometimes you probably don't think about this, Joe and Mary, but you guys got $1 million asset sitting right here on the call, and that's you, Joe. You're bringing in $1 million into your family, and guess what? That's not including any pay raises, any overtime, any pensions or 401k contributions. So the problem is if you passed away today, your family's not going to receive any of that $1 million. So what they'd recommend is to have at least 5 years of your income coming in. So 50 times 5 equals what?
200.
250,000,
250,000.
right? So that's what they would recommend to have in place, right? All right. So 450. So this is a total of what? 480,000. If you pass away today, that's what your family would need. Does that make sense?
Mm-hmm.
Now,
Yeah.
what's going to happen over time? Well, over time, hopefully, the mortgage starts getting paid off a little bit, right?
Yeah. So
Yeah, right.
decrease, but
Over time, the kids are getting older. They're kind of moving out of the house, and now you're in retirement. If you pass away, I mean, you're not even making any income, so they're not going to lose the income anymore. So now all you need is what? Now you need just enough for when you pass
no.
away, right? So that's where we set up today, whole life that's going to be in place for your entire life. You lock in today, and it's going to be there what? When you pass away, no matter what. But also, we don't know, there's always a possibility that, you could pass away before you reach retirement, right?
Yes.
And if you pass away, the question is if. If you pass away before you reach retirement, then that's where you would recommend to have term life in place. And then to make sure that you capitalize on your benefit, we would have accidental death benefit as well, because they found that if you pass away before you reach 65, the majority of people that die before retirement pass away to an accident more than any other cause. So that's how we would set it up. So in this situation, I would probably tell this person that they would probably need like 50,000 of whole life minimum. I'd probably recommend them to get more, but I tell them at least 50,000 a whole life because that'll be in place now until forever. And really, I would look at what their projected funeral costs are. Because if you're 30, that means that it's probably going to be when you're 50, when you're set, it's probably going to be around $60,000, 50,000. So, anyways, I'll show them how much it's going to cost them. I'll say it's going to cost you 50,000 when you die. The next thing, though, is then you would probably need to have some term life. So I would say probably 230 with term, and then 200 with ADB. And now I got them their 480,000, and it's affordable. This makes sense why they would need this, and this makes sense how we would cover that need.
Yes.
Pretty straightforward stuff, right? Now,
Yep.
is this person a gazillionaire, or is this like an average Joe that makes $50,000 a year?
Yeah.
Average.
Average Joe that makes $50,000 a year. How much coverage does he need? How many
At least
people do you know
40.
that have $480,000 of life insurance?
Not many.
Not many, right? So what does that mean? That
Means
the
you got
majority of people walking around in the United States that love their family dearly are leaving their family exposed. The people that they love and care about the most and they vowed to protect, they're not protecting them. They're setting aside more money on a monthly basis for Starbucks, Dunkin' Donuts. Some of them are paying for subscriptions that they don't even know they're paying for right now, more than they're setting aside to protect their family with life insurance. If the average person needs 480,000 and this is just Joe who makes 50 grand a year, could you imagine what other families truly need and what they really have? Most families don't have 480,000, they don't even have 100,000. So there's a
yeah,
huge gap. There's a huge need for what we do out there. And I would tell you guys that if you want to excel in this business, you got to really believe in what you do and have enthusiasm around it and truly understand our job and our mission. It's not going to be easy. We're fighting an uphill battle. It's like we're pushing rocks up a hill. I mean, that's pretty
yeah,
much what we
Tommy.
signed up for. It's not very glorious. You're not going to be on the news today because you protected a family. Okay. Firefighters are diving into burning buildings. God bless them. They're protecting families. Policemen wake up every day, put a gun on their hip, and they protect families, right? We protect families as well. It's not going to be glorious, but we get to protect and serve the people that are going to protect and serve us, the people that build up America to what it is today. Most people aren't cut out for this, and that's why we're not most people, right? That's why we're not most people. This is required. It's a very special individual, a call to serve, a call to service. Our job is to serve, not to sell. By meeting with family and me going over this, am I trying to sell them some life insurance? If they need it, heck yeah. That's my job, right? If I got a kid who's sitting in the living room and his dad needs life insurance and he's talking to me right now, I got a duty to get that guy some life insurance and talk some sense into him. You're 40 years old, you got a wife, you got kids. Okay. Why do I was 22 years old and I had a $250,000 policy, guys. So when I'm meeting with someone who's 40 years old and they have no life insurance, and I'm 22 and I got a 250,000, I'm paying 168 a month at 22 years old for some life insurance. This guy's setting aside no money. And if he dies, all kind of people are going to be really messed up. His whole family's going to be, who knows, what's going to happen to the wife and the kids. I don't like to go down that rabbit hole, but I think we must. Can we explore that for a minute, guys?
Yeah, the name.
Let's get emotionally tied into this real quick, okay? Let's get emotionally tied into this. So if we go down that rabbit hole, we meet with that client. We don't meet with that client. I don't call him for some reason. I'm nervous. I'm having a bad day. I don't call him. When I call him, I do a bad job on the phone. He don't book an appointment with me. Maybe I do a great job on the phone. I book an appointment with me, but then I no show him for some reason because I'm a knucklehead. Or maybe I do show up, but I was physically there, but mentally I no showed him. I was having a bad day. I'm worried about my dog who threw up on the carpet earlier. So now I'm not thinking too clearly with the guy. I'm fighting with a girlfriend or something like that, and now I don't give a good presentation. I give a bad service to him. For some reason, I don't sell him a policy, right? For some reason, but it was my responsibility to do so, but I don't do it. He dies. Now his wife, now his kids have no money coming in. So what do you think's going to happen with the mortgage that's due this month? Probably not going to get paid. And then that happens for 2 or 3 months. And then what happens? They do what's called home foreclosures, right? So I'm not even going to go into to all the detail about home foreclosures, but I could right now. I went down that rabbit hole. I was like, what's the number one reason why homes would get foreclosed? Guess what it is? Loss of income. So I'm saying, loss of income. Why would someone lose their income? Let's figure that out. Number one reason why people lose their income, they call it the D's. It's death, disability, and downsizing, right? You had income, then you died. Income's gone. You had income, got disabled. Income's gone. You had income, company laid everybody off, got fired, downsized, cut people. Income's gone. Well, when the income's gone, that's the number one reason for home foreclosures, right? So uh, the mortgages, that was a concern. Um, and I forget why I was going down this little rabbit hole about mortgages, and I got off topic real quick. What was I going to go? What was I trying to wrap up with you guys?
Getting us emotionally invested.
Yeah, yeah. So then you think about, yeah, then you got to think like, so if they get kicked out of their house, now what? Then the kids got to go move in with like grandma. Instead of going to the school that they're going to, grandma lives in a different school district. Now they got to go to a different school district. So not only do they lose their dad, they lose all their friends. And mom, where's mom at? Mom can't work 80 hours a week. So not only do they lose a dad, now they picked up a part-time mother. They went from two parents to half a parent overnight. She can't be there physically, can't be in two places at once. And when she is there, mentally, emotionally, probably not there like she needs to be. And the biggest thing is financially, just not the same. So what we do is we help them by making sure, right, that the house is paid off so they don't have to move. We make sure income's coming in. So guess what? I know she can't be financially, we could get her taken care of, so she could be there physically now. She could be there emotionally and mentally for the kids. Does that make sense? So like I go down this rabbit hole. I'm like, man, if I don't protect this family, these kids can end up losing their friends, picking up bad friends. What if they end up like joining a gang or something because they lose all their friends? So now they're trying to get friends, and the only friends they find, they just get picked up by a gang, and now they end up doing bad stuff out there. And this kid was supposed to be the president of the United States one day. He's supposed to be curing cancer. He was on that path, and all of a sudden, boom, dad dies. Mom never had life insurance. Now she's living in the ghetto, has over this, dealing with that, dealing with that. She can't be in two places once. He's picked up over here, and now he's in jail. All because I was lazy and didn't want to make the phone call to get some life insurance. Like, that's how crazy that I get about my job. You know what I mean? I don't know if you guys can get that deep and real about it. But when you see this stuff happen with your own eyes, it becomes a lot more serious about what we're doing. Up until that, you just think you're just making some phone calls. So, anyways, that's my little two-bit on that. So, I don't know if that makes any sense. But uh, today was a good session. I'm glad you guys spent some time with me going over this. And this is a great foundation for you guys to build off of all the stuff we went over today. So, have a
Hey,
great one. Appreciate
hey,
your time today.
hey, Tommy, I have
Thank
a
you.
question. I have a question for you. Maybe after the meeting, take 2 seconds if you don't mind.
Yeah, I'll just hang out on here. You guys can head off for today. Awesome job spending some time. Let's get our license knocked out as quick as possible. If you guys are on that path, okay, be relentless, be persistent, be resourceful, do whatever it takes to make it happen. Have a good day today, guys. Joey, I'll hang out here for a minute. Which you guys can hang on and listen to Joey's question too if you want, obviously.
You too, Tommy. I have one real fast. It's Vic. But I'm taking my test tomorrow morning, like early in the morning. I'm gonna be up at 3. I'm still gonna practice a little bit with a little bit of the exams, just quick ones. the fast ones, I learned that you do the quick, just 10 question, 15 question ones,
What's your
pound those
question?
out. But it's for my test. Should I like I don't know how to word this. Like I'm not trying to be over prepared, but um should I like just relax for a little bit and then before the test do my studying, or study now, take a break, and then at least an hour, because I plan to be up an hour before my test. Well, 2 hours before, study for an hour. Just go over my cards.
So what I recommend when you guys are studying is study super hard, and then the night before the test, like leave the information go, like review it. But I'd go like just relax, wake up the next day early, get a little bit of caffeine in you, even if you're not a caffeine person, get a little something to pep up because it does trigger your brain to think a little bit faster. So it's a little bit of a cheat code. I'm not a caffeine guy at all, at all. But if I did have an SATs today, I would probably, like back in the day, my dad gave me a caffeine pill for when I had to go take my SATs. I remember I had her, and so I was like, all right, because I didn't drink coffee. I was in like high school or whenever. So, anyways, I think like that's all. That's the answer. Joey, you got a question?
Yeah, I do, but it's a little. I don't know if everybody needs to be here for it, kind of thing.
All right, all right, cool. Well, all good then, guys. Have a good day today. I appreciate you guys hopping on. Let's get it.
I
Good
Thank
have
you.
a
luck with your
question,
studies.
Tommy.
Thank you so much.
Yep. What, Shayna, you say you had a question?
Yes. Okay, they told me that my training is expired, so I was trying to get back in there. So they changed everything. So they finally got my password to work. So do I just not try to finish the train, or do I just do the test?
Um, you when you do you have to get a certificate of completion, I think, in order to take the test. So did you
Okay,
get
so I
that?
have to finish the extension, get an extension for the training.
Probably if you didn't get your certificate of completion yet. I don't know if they'll let you take the test without that. You
Okay.
could you could try, but I
Okay.
think they might ask you for certificate of completion.
Yeah, because the website they keep sending me to is to just take the test instead of getting back into the training
Okay.
where I left off at. So I don't.
Well, I mean, obviously you're gonna need to study to take the test anyways, unless you think you got it down. So yeah,
Oh, I have to finish studying. That's what I was saying. Like, because I was just
yeah.
on number 15.
Mm, yeah. So you just got to extend it. Get
Okay.
the extension on there.
Okay.
Yeah. Let us
Thank
know
you,
if you have
Tommy.
any issues. Let us know if you have any issues with it.
Okay. Thank you, Tommy.
You got it.
You have a
Have a
great
good day
day.
today. Yes. See ya.